lecture on inventory. And generally speaking, there are two types of inventory systems, and three methods that we'll be worried about in this course. Here are the systems. Number one, perpetual. Number two, periodic. Okay? Perpetual and periodic. If something is perpetual, it means what? All the time. Continuous. Okay? If something is periodic, it means what? Intervals. Okay? Intervals of time. Alright? So, here's the idea. If I have a perpetual inventory system, which most people do these days, I know at any point in time, any time during the month, year, whatever, I know precisely what my inventory balance is. Always, perpetually. Okay? If I do a periodic inventory, which you do not see this a lot anymore, stores used to close for, a day or two at the end of the year to take inventory. Literally close the door, sit down and count everything. That's a periodic inventory system. Okay? In a periodic, we don't know the inventory balance all the time, perpetually. We only know it at certain points along the way. Maybe the end of the month, end of the year, whatever the case may be. Okay? So, we will be responsible for both. Again, perpetual is what you see mostly now. Most everything is automated. It's very easy to know exactly what the inventory balances are. So these are our two systems. Okay? Perpetual, periodic. Within these systems, we have three methods. FIFO, LIFO, and average cost. Okay? Average cost. Okay? FIFO, LIFO, average cost. Now, I'm not going to ask you to do average cost under a perpetual system. I will ask you to do it in a periodic system. So that's why I did not include it up there in perpetual. Now, FIFO means this. First in, first out. First in, first out. LIFO means, there you go, last in, first out. Okay? Now, there's a little more to this than meets the eye. The first thing we have to do is we have to understand the methods. We have to understand what to do and why these are different and what exactly that means. The bigger picture, and the one that I kind of want us to catch on to, is which one of these I choose, and it is a choice that accounting management has to make within a company. Which one of those I choose does impact my financial statements. Okay, so, and it can be a pretty significant impact. So here's where we're going to start. Here, two systems, perpetual, periodic, FIFO, LIFO, average cost. Where we are going to start is perpetual, and the problem that we're going to work today is going to deal with FIFO, first in, first out. Okay, so look on page 348. That's where we're going to start. And it is important to make sure that you stay organized in this problem because not so much FIFO, but when we do LIFO, things will get pretty messy pretty quick. So, make sure that you have good columns set up and everything because it can get kind of crowded. So, just be aware of that as you go in here. I only need 3 columns, and they're pretty simple because I'm only going to really do 2 things. There's 2 actions that I need to be worried about. The first thing that I can do is I can purchase inventory. So I need a column for purchases. I can sell inventory, so I need a column for what's sold. And then I need a balance column. Okay? So date, purchases, sold, and balance. If you look at the example in the book, it looks a lot more complicated than that. That's all you need. They put all kind of stuff in here. The way that I do it, those 4 columns accomplishes the exact same thing, and it's a little bit clearer in my estimation. So those are our 4 columns. Okay, so here we go. On page 348, it says FIFO perpetual inventory.
Which number?
7-1A, all the way down at the bottom. This
Okay.
one goes over into page 349. It says beginning inventory at RTE Office Supplies and data on purchases and sales for a 3-month period ending August 31, 2014 are as follows. Okay, and this is the, when you get to exam time, this is sort of the setup that you'll see, and you got to know what to do with it. Okay, so the first thing you're going to be given, always, is our first day here happens to be June number 1. And you will see that under transaction, it just says inventory. Okay, so all they're saying is, we didn't buy or sell anything on June 1st. We just have some inventory from previous months that we're starting the new month with. Okay, so what I have is this. I have 500 units. So I'm going to go all the way out here to balance. 500 units. These units cost me, is it 30? Did I get that number right? Good. Yes, $30 a piece. So if I have 500 units, all of them cost me $30 to get my hands on. That means I have an inventory balance right now of $15,000. So let's think about it a little bit. The month that comes before June is May. So if I print financial statements on May 31st, okay, remember the ending balance in May becomes the beginning balance in June. So what I would likely see is on inventory, on the May balance sheet, I would see inventory $15,000. Tells me how much I have. Okay? Now, underneath that transaction, the June 1st, we have the June 10th. So June 10 transaction. What do we do on June 10th? Alright, we bought more inventory. Alright, so the 2nd, June 2nd, June 3rd, June 4th, all that went by, nothing happened. Alright, June 10th finally comes along, we buy some more. So we got to go to what? We got to go to purchases. What did we buy? Well, we bought 1,500 units at $34. Okay? The total there is $51,000. And the question we always want to ask, and this column over here is where it can get kind of messy, so be sure you've got your little system down. What we want to do out here in the balance column is we want to update. Alright? So I want to know, when I added this, what do I now have in inventory? Well, I still have those. Right? Those didn't go anywhere. I didn't sell anything. So I still have these. I still have 500 at 30. And now I have what? I have added to that 1,500 at 34. Okay? So now I have 1,500 at 34, 51,000. Alright? So now since I added this inventory, now notice, I'm not replacing this 500. I still have those 500 original. Okay? I'm just what? Adding to it. Okay? So now I have 2,000 units at a total value, what I paid for them, of $66,000. So now, we're under perpetual. Alright? So if I made a balance sheet on June the 10th, we'd say inventory, not 15, but 66,000. With me? Okay? So, now, you'll notice, back in here, nothing happens from June 10th all the way to June 28th. Okay? So if I ask you this, remember it's perpetual, we always know the balance. So if I ask you this, what is the balance in inventory on June 14th? That's what? It's still 66. Nothing's happened. Remember, one of the basic things we talked about is these accounts want to stay the same. I have to force action on these accounts. And for an inventory account, it's either what? It's either a purchase or a sale. Alright? So, June 28th comes along. June 28th, we finally make a sale. We go almost a whole month without selling anything. Alright? On June 28th, we sell 750 units. And we charge, is it 50? 50 per, is that right? Yeah, that's right. Okay. The total there FIFO means what? First ones in are the first ones out, okay? So anytime you get to a sale transaction, just stop, breathe, make sure you're doing the right thing, okay? Here's how many I sold. Here's what I've got, okay? So the question is this. Which did the 750 come from? They come from here, or they come from here? All right, the answer is both. Why? Because we're using FIFO. The first ones that I got, the first ones in, are going to be the first ones out. So here's what this sale is made up of. All right, I go over here. I see that I had 500. Okay, so if I sold 750, then what? All 500 are gone. Okay, so under this sale for June 28th, I'm going to sell 500. Okay, 500 at what? What did I get them for? I got them for 30. So 15,000 is out. Now what else? I sold 750. I got to pick up what? I got to pick up another 250. Where does that 250 come from? That 250 comes from here. Okay, the $34. So 250 times 34. That number is 8,500. 8,500. All right. So again, the question after we record this is, what am I left with? Well, before the sale, I had 500 at 30, 1,500 at 34. What have I got now? What happened to those? They're gone. Okay. What happened to these? I sold 250. So that means I have what left? 1,250, all costing 34. Okay, and that figure is 42,500. 42,500. Okay. So you've seen a purchase, you've seen a sale now. We making sense? Yes.
And what happens to the, like, it says 750 times 50 is 37,500. Where does that go?
I'm sorry?
Like, the sale is 750, the unit's 50, total is 37,500. So where is that going?
Oh yeah, what they're telling you is that you're selling this for that price. What I'm trying to keep up with is on the inventory side. Okay? So what we'll do at the end, this figure, we'll add all these up, and sort of the big final fireworks at the end is we'll get cost of goods sold from here, and I'll ask you, okay, what's gross profit? So what you have to do is you have to go back through here, get these sales amounts, add them together, subtract out our cost of goods sold, and get gross profit.
So basically ignore that number.
Right now. Yeah, right now. Anytime we're over here, what I'm concerned with over here is I've got to get my inventory balance. Okay? So if I start mixing sales prices with inventory over here, I'm going to get a bunch of garbage over here. So I gotta stick with my inventory costs. Okay? And that's an easy mistake to make.
Where did you get the 8,500 from?
Did I do the math right? Probably not. 250. Yeah, that's it. 250 times 34.
Where are you getting that from? Oh, okay.
You got it? Okay. All right, other questions? We okay? All right, now, June 30. June 30, we have another sale. We sell 250 here. Where's this one going to come from? This is pretty obvious. There's only one option left, so they all have to come from here. All right. So these are the $34 units, so 8,500 again. Now what's left? We had 1,250. We sold 250. So what's left? 34,000. here to look funny? All right, July 5th. July 5th comes along and we make another sale. We sell 100 units, so 100. They still all come from where? They all come from the $34 batch. 3,400. Another thing I like to do, and I don't do this all the time, only when I think about it, is you can put you a date out here just to kind of help you keep up with what exactly is what. That's not a deal breaker, but it just kind of helps you keep up with what spaces are, deal with what date. All 100 of these are going to come from the $34 batch. So we're left with what now? 1,000 minus 100 gives me 900 times 34. 900 times 34 is 30,600.
So, just out of curiosity, when you do the per unit part, like for July 5th, it's 55. Where's 34 coming from?
Yeah, that was what she was asking. We'll come back at the end and figure out how much we sold, revenue. We're worried about what though? And that's what I was saying. If we start mixing and matching sales price and what we paid for it, because you have to remember, we have to pay a certain price for the inventory. We have to come around and sell it for a certain price. We can't mix those prices when we're keeping up with our inventory.
Okay.
I want to know, at the end of the day, how much inventory is left, what I paid for it, and what the value. Does that make sense? I'm not concerned with selling price at this point. Okay? We will be, but we're not yet. Okay? We okay on that? I know that's a tougher one there. We okay? All right. July 10. July 10 we have a purchase, 3,600. At 35. That's 126,000. So again, we'll go out here, and what have I got left? I still have those. We're not replacing, we're just buying more. So I still have these, 900 at 34. And now I have these, 3,600 at 35. And that number is 126,000. July 10. Got that one? Good? We do. July 16th. July 16th, we have another sale. We sell 1,800. So again, we have to think a little bit on the sale. We are under first in, first out. So this is going to be a two-part deal here. Out of these, and again, that's my inventory balance up to this point. Which ones did I acquire first? Well, I got those first, okay? So if I sold 1,800 and I only have 900 of those, that means what? On July 16th, all 900 at 34 were sold. Okay? Now, according to the information, I sold 1,800. I'm only accounting for 900. So that means what? The remaining 900 come from here. Okay? So 900 times 35. 900 times 35 equals 31,500. So, what's left? All those are gone, right? Okay? I don't have 3,600 of these anymore. I have 3,600 minus the 900 that I just sold. So what's left here is 2,700 at 35. 2,700 multiplied by 35 is 94,500, and that's my new inventory balance. Got it? All right, anything look funny right now? Numbers look funny, anything? We okay? All right, last one for July is July 28th. July 28th, we have a sale. We sold 1,700. This will be pretty straightforward here. We only have one batch of inventory, so it's all going to come from there. So 1,700. And I paid $35 for each unit there. That's 59,500. So what's left over? Well, before that sale, I had 2,700. I just sold 1,700. So what's left is 1,000. And they all cost $35. So my new inventory balance is $35,000, and that's on July 28th. All right, that takes care of July. Any number up there that you don't know where it came from? Are you following the logic? I mean, once you sort of catch on to it, it's pretty repetitive, but I don't want to just assume that you have it, because if you haven't seen this before, especially, it's kind of hard to catch on to. August 5th. I'm going to have to write a little smaller here, so just bear with me. August 5th, we have a purchase of 3,000, so we'll go into the purchases column. 3,000. Those 3,000 cost me $35.80. See y'all. Okay. So the amount, 3,000, multiplied by 35.80 is 107.4. 107.4. So again, I have to update over here. What have I got now? I still have those. Remember when we purchased, we're not replacing, we still have these. Okay, so 1,000 at 35. That's 35,000. And now I have these, 3,000 at 35.80 is 107.4. Okay? You happy? Got it? All right, August 14th, we have a sale. We sold on August 14th 2,000. First one's in, the first one's out, so this sale is going to be made up of what? We got these first, so these are going to be the first ones out, okay? So all 1,000 of those are gone. Then what? Then we drop down, okay, we have 3,000. We sold 2,000, we've accounted for 1,000, so the other 1,000 are going to come from at 35.80. Okay, so 35,800. What's left? Those are gone. Okay, do we still have 3,000? No, we got rid of 1,000. Okay, so now we have 2,000 at 35.80. 2,000 multiplied by 35.80 is 71,600, and that is my August 14 balance. We all right? You got it? All right. August 25. August 25. We have a purchase. We bought 500. 500. At 36. Did I get the right number there? 18,000 is my total. So I just need to add it to these. 2,000 at 3580 is 71,600, and now in addition to that, I have 500 at 36. Sorry, those in the back, I know I'm running out of real estate here, but there's only one more, so we can fit it. There, 500 at 36. And then finally, the 30th. On the 30th, we have a sale, 1,750. These are the first ones in. So we have what? We can accommodate all 1,750 with those. So 1,750 were sold at 3580.
You mind moving the podium over just a tad bit? There you go.
Balance there is 62,650. So what am I left with here at the end? I had 2,000. I just got rid of 1,750 of those. So I have 250 of those at 3580. 250 times 3580 equals 8,950. And I've also got these 500 at 36, which is 18,000. Okay? Now, a couple of things. I want you to notice something about the inventory that I'm acquiring, specifically what the prices are doing. Okay? You'll notice what? My first purchase was for 34, then 35, 3580, and 36. Okay? So, for me to get my hands on whatever it is I'm selling, what's going on here? Prices are going continually up. Okay? So we have a name for this. It's called a period of rising costs. Period of rising costs. Okay? Period of rising costs. Again, what's telling me that? What am I paying for the inventory? Is it going up or is it going down? In this case, it's going up. So I'm in a period of rising costs. If you look at question number 2, here's what it says. It says determine, and Hannah knows this is where we're bringing back sales. It says determine total sales and total cost of merchandise sold for the period. Okay, so this is part 2. We want to know sales and cost of merchandise sold. Okay, so how am I going to get these sales figures? I got to go back and do what? I got to go back. Okay, anytime you see sale, all right, so the first one is on June 28th, sale, $750. We sold for $50 per unit for a total of $37,500. Okay, so what I need to do is I need to take that $37,500. That's how much revenue I bought in. Okay, it doesn't have anything really to do with the inventory side. It's not what I paid to acquire. It's what I actually sold it for. Okay, so I take that $37,500. I find my next sale, which happened on June 30. From that sale, I got $13,000, so I add that to it. On July 5th, I made a sale. I made $5,500 on that sale. Y'all with me? See what we're doing? We're just looking for the next sale. Okay. On July 16th, I made a sale that was $100,800. On July 28th, I made a sale that was $102,000. Not that much. $102,000. On August 14th, I made a sale that was $120,000. And on August 30th, I made a sale that was $105,000. So if I add all that up, I get total sales of $483,800. Okay? Again, where is this number coming from? I'm just looking at the information they give me, and I'm saying, all right, whenever I made a sale, number of units multiplied by the selling price. And they gave us the total here, which is really nice. So you know where I'm getting that number. Make sense? Good? All right. The cost of merchandise sold, what are we trying to figure out here? Remember, if you go back to chapter 6, okay, what we do is, whenever we purchase inventory, when we acquire inventory, we record it to the asset merchandise inventory. Okay? We don't charge that cost as an expense until we actually sell the merchandise. Okay? So, where I'm going to get this number is I've got to look at my sold column. Okay? So, here's our little list here of everything we sold. So to get the cost of merchandise sold, I got to do what? I got to go right down there and add up those numbers right there. Okay? The total, if you...
So what date do the 900 times 35 and 31,500 and the 1,700, what dates are those with?
Where are you?
Is, okay. And then the 900, 34, 30,600.
Over here.
Yeah, those three.
These.
What dates are those?
This is the 16th. Right?
Okay. That was the only thing that was throwing me off. So I was trying to make sure I had that right.
Yeah. 16th.
Okay.
Right? Okay. So to get